most traders lose money in exactly one spot: the chop. The market goes quiet, they get bored, they force trades into a range, and they bleed out one small stop at a time. Then, the moment they finally give up and step away, the market explodes without them. Today, I'm building a system that does the exact opposite. It sits on its hands while the market compresses, and it only pulls the trigger at the precise moment volatility releases. And only when an adaptive trend filter confirms the breakout has real legs behind it. We're combining two of the most battle-tested tools in quantitative trading: John Carter's Squeeze Momentum Indicator and Kaufman's Adaptive Moving Average. The entire system, the Pine script, the logic, the risk model, was built end-to-end with GPT 5.6 Sol, and I'll show you exactly what to say to it so you can rebuild or modify every piece of this yourself. And we're wrapping the whole thing in proper risk management: a TR trailing stops, a fixed 1.5-to-1 reward-to-risk target, and rule-based position sizing. Full Pine script code, the complete deployment guide, everything. It's all waiting in the Alpha Cartel Discord, link below. Let's build it. Before we touch code, understand why this combination works. Because if you don't understand the logic, you'll abandon the system the first time it hits a losing streak. And every system hits losing streaks. Markets cycle between two states: compression and expansion, volatility contracts, energy builds, and then it releases. That's not a prediction, it's structure. The problem is that a squeeze can release in either direction, and half the traders using squeeze indicators get chopped up taking every release blindly. That's where the second layer comes in. Comma isn't a normal moving average. It measures how efficient recent price movement has been, how much of the movement was actual direction versus pure noise, and it adjusts its own speed on the fly. In a clean trend, comma speeds up and hugs price. In chop, it flattens out and refuses to move. So when we demand that price is trading above comma at the moment of the squeeze release, we're filtering out the fakeouts that fire against the underlying flow. 3 independent conditions: compression releasing, momentum building, trend confirming. All 3 have to agree, or the system does nothing. That discipline is the edge, not any single indicator. This is infrastructure, not fortune-telling. Let's break down the first component. The squeeze momentum indicator compares 2 volatility envelopes calculated on the same look-back period. Bollinger bands are built from standard deviation. They expand and contract fast, reacting to every burst of volatility. Keltner channels are built from average true range. They're smoother and slower. Normally, the Bollinger bands live outside the Keltner channels, but when the market compresses hard enough, the Bollinger bands shrink so much they slip completely inside the Keltner channels. That's the squeeze. In the code, it's one clean condition. The lower Bollinger band is above the lower Keltner channel, and the upper Bollinger band is below the upper Keltner channel. Both true, squeeze is on. On our chart, the background shades orange while the market is coiling. The release is what we actually trade. The moment the bands snap back outside the channels, squeeze was on last bar, off this bar. That's the trigger event. Energy stored, energy released, but direction matters, and that's what the momentum histogram is for. Carter's formulation takes the closing price, subtracts a blended anchor, the average of the mid-range and the simple moving average, and runs a linear regression over it. The output is a histogram that tells you which side is winning the compression. We demand 2 things from that histogram. It has to be positive, and it has to be rising bar over bar. Positive alone isn't enough. Momentum that's positive but fading is a breakout running out of gas. We want positive and accelerating. Buyers loading the release. Now, the adaptive layer. Kaufman's Adaptive Moving Average was designed by Perry Kaufman specifically to solve the problem every moving average has. Fast averages whipsaw you in chop, slow averages get you in late in trends. Comma refuses to pick one speed. It calculates its speed from the market itself. Here's the mechanism, and it's genuinely elegant. First, it computes an efficiency ratio. Take the net distance price traveled over the look-back window, say 14 bars, and divide it by the sum of every individual bar-to-bar movement along the way. If price went straight up, those two numbers are nearly equal and the ratio approaches 1. If price zigzagged violently and ended up nowhere, the net distance is tiny compared to the total path and the ratio collapses towards 0. That ratio then gets mapped between two smoothing constants, a fast one defaulting to a 2-period EMA speed and a slow one at 30-period speed, and the result gets squared, which punishes noisy markets even harder. The final smoothing constant drives the average. Efficient market, moves fast. Noisy market, barely moves at all. On our chart, the line renders cyan when price is above it. Longs are permitted, and flips amber when price is below it, which means the system stands down completely. No exceptions, no discretion. If the close isn't above at the moment of the squeeze release, there is no trade. That single filter is what keeps this system out of the counter trend fakeouts that destroy naked squeeze traders. So let's stack the full entry logic, because this is where the system either earns its keep or it doesn't. Condition 1. Squeeze release on this exact bar. Not squeezes off. Released right now. Squeeze was on the previous bar and off on the current bar. That precision matters because it means we enter once per compression cycle at the moment of ignition instead of chasing an expansion that's already 3 bars old. Condition 2. The momentum histogram is above 0 and higher than the previous bar, positive and building. Condition 3. The closing price is above the line, trend confirmed by the adaptive baseline. And one structural rule. Position size must be flat. This system never pyramids, never averages in, never stacks entries. One position, one thesis, one clean risk envelope at a time. When all 4 checks pass, a lime triangle prints under the bar and the strategy fires a market long. That's it. There's no discretionary override, no but it looks strong exception. The entire point is that the rules make the decision so you don't have to. Now the part that actually determines whether you survive, the risk model. Entries get all the attention on YouTube, but exits and sizing are where systems live or die. Position sizing first. Every trade commits a flat 10% of current portfolio equity. Current meaning it compounds with the account and shrinks in drawdowns automatically, and applies a flat 10x leverage multiplier to that slice. So, the notional position is equity times 10% times 10 divided by price. On a $10,000 demo account, that's $10,000 of notional exposure per trade. Let me be blunt about the leverage, because I'm not going to hand you a 10x system and pretend it's gentle. Leverage amplifies both sides of the ledger. A 2ATR stop out on 10x is a meaningful hit to equity. Historically in testing, this lands in the low to mid single digits of account value per losing trade, depending on where ATR sits relative to price. That's survivable with discipline and catastrophic without it. Run these numbers on your own account size, on demo, before a single live dollar touches this. The stop loss is where this system gets smart. At entry, the stop plants at the lower ATR band, the close minus 2 times the 14-period ATR by default. From that moment on, the stop only ratchets. Every bar, the code takes the maximum of the current stop and the new ATR band. It can rise. It can never fall. So, as the breakout extends, the stop climbs underneath it, converting open profit into protected profit, but it never widens risk. That asymmetry is the whole game. The take profit is deliberately rigid, 1.5 times the initial risk. If the ATR stop distance at entry was 100 points, the target sits 150 points above entry, locked at the moment of entry. Fixed R multiple targets keep the math honest. With a 1.5 to 1 payoff, the system only needs to win somewhere around 40% of the time to sit at break-even before fees, and anything above that is edge. Whichever level price touches first, trailing stop or target, closes the trade automatically. Getting this running takes about 2 minutes. Open TradingView, load a chart. Crypto perpetuals on the 1 hour to 4 hour timeframes are the tested habitat for this build. Open the Pine editor, paste the full script from the Discord, and add it to chart. Commission is pre-configured at 0.05% per side, so your backtest isn't lying to you. Match it to your actual exchange fee before you trust a single statistic. Every parameter is exposed in the settings panel, grouped into 3 sections: the squeeze engine, the comma baseline, and the risk block. And here's how you optimize without curve-fitting yourself into a fantasy. Tune one group at a time and start with the ATR multiplier. The range between 1.5 and 3 is where the action is. Stop distance dominates expectancy more than any entry tweak ever will. Tighter stops mean more losers but smaller ones and a closer target. Wider stops mean fewer stopouts but bigger hits. There's a sweet spot per instrument, and it moves. If your pair is noisy and you're getting too many weak signals, widen the Keltner multiplier from 1.5 toward 2. That demands a more violent compression before a squeeze even registers, which cuts frequency and raises average signal quality. On lower time frames, lengthen the comma efficiency window from 14 toward 20 or beyond to stiffen the trend filter and judge your results properly. Win rate alone is a vanity metric. Look at profit factor and maximum drawdown together. A system with a probabilistic edge and controlled drawdown beats a 90% win rate with blow-up risk every single time. Then, walk it forward. Optimize on one slice of history. Validate on data the optimizer never saw. If performance collapses out of sample, you didn't find an edge, you found a coincidence. Set your expectations like an adult. This is a breakout system, which means its personality is streaky. In trending, expanding markets, it can string together clean winners. In dead range-bound conditions, squeezes will release into nothing and you'll take a sequence of small stop-outs. That's not the system breaking. That's the cost of doing business. And the 1.5 R multiple plus the ratcheting stop exist precisely to make the winners outweigh the bleed. One more habit that separates operators from gamblers. Keep a log. Every stop-out, note the regime. Was it a dead range? A news candle, a counter-trend release that slipped past the filter. After 20 or 30 trades, patterns emerge, and that's when a parameter change is justified by evidence instead of frustration. Never re-optimize because of one bad week. No backtest guarantees anything forward. Market regimes shift, edges decay, and any performance you measure is probabilistic, not promised. What this system gives you is what retail traders almost never have: a fixed, mechanical process with predefined risk on every single trade. Speed, structure, discipline. The infrastructure edge. Everything from this video is packaged and waiting in the Alpha Cartel Discord, the full PineScript v5 source, the complete HTML deployment guide with every parameter explained, and the copy-paste prompts if you want to rebuild or modify this system with GPT 5.6 Sol yourself. Link is in the description. Everything here is educational only, not financial advice. Test on demo, size like you plan to survive, and I'll see you in the next build.